All right, guys, so quick catch up. We've got, obviously, US afternoon is going to be slow. Or I should say our afternoon, the US morning, but we have a US bank holiday, of course. So we've got Mario Draghi, who is going to be speaking. So just ahead of Draghi's comments, I thought I'd just have a look. Well, first thing, we don't know what he's going to say yet. So his comments might not be market significant. What I would say is just at the moment, something of note, if I just make this euro-dollar chart a little bigger. We broke lower a couple of hours ago, and it's been a very slow move. Firstly, we hit the pivot, and that held things up for a good hour or so, and then we've just drifted, and we're just down to Friday's low now, 107.11. Payroll's low. Big dollar strength off that uber strong labour market data out of the US. We broke this briefly yesterday, but it was a false breakout, and so this is still of interest, this area 107.11, despite the fact we broke it yesterday. But if we are to continue this downward trajectory through the US afternoon, which might happen if, let's say, Draghi's dovish when he starts speaking, then it can easily get down to yesterday's low. Okay, anything below yesterday's low, that's a 6-month low. Okay, so I thought I'd just let's just have a little look at the ECB, given that we might be having Draghi speaking here. Got a few charts to maybe just talk through. This is a long-term look at two things: inflation and ECB interest rates. This is going back to the very birth of the ECB, okay, as the Eurozone was created and the single currency got up and running. So we had the central bank for this monetary union. So inflation is the coloured in section. We've got a blue dashed line on here. That's the ECB's inflation target, that is 2%. And then I think that's green. The green line is what the ECB call their refinancing rate, which is their base rate, it's their interest rate. Okay, so it's pretty interesting for a couple of reasons. Firstly, we had inflation so stable in the pre-crisis years, so solid and stable at the target, and this really breeded that complacency, I think, that ultimately led to the excesses that created the crisis in the first place. But obviously when the crisis hit, the violence started with the volatility in inflation dramatically increasing. Big dive into deflation off the back of the crisis, very sharp rebound. And look where Mario Draghi turns up. He replaces Trichet at the end of 2011, and actually I've got a new solution. I've come up with a new plan of action for the ECB to, or I should say for the Eurozone, to avoid the deflation trap. Well, shouldn't they just get rid of Draghi? Because look at this chart. As soon as he arrived in office, inflation started dropping sharply and has done nothing but since. So maybe the answer is get rid of Draghi. Is he the problem? I'm joking. I would say without Draghi, the ECB and the Eurozone may well not exist. Draghi is the man for this job, but it seems to be a weird timing, the reverse indicator of Draghi turning up and inflation falling off a cliff. Anyway, you can see what's happened with interest rates, and particularly over the last few years, just gradually stepping lower to zero. So this. Interest rates at the ECB have been at 0.05% now for just over a year. Okay, they've been at ground zero for over a year. Inflation, well, we dived into deflation territory, and actually inflation went more negative at the start of 2015 than the financial crisis year of 2009, which is pretty phenomenal. Then we got the rebound, but now inflation's back to zero. So are we still in a downtrend for inflation? Do we still have a risk that is the deflation trap? Or was this bottom back at the start of the year the bottom, and this is the beginning of a reversal? From a technical point of view, you certainly wouldn't say that this is a reversal of the inflation trend. I'm just going to get off the mic briefly, just in case we get Draghi comments. Back in a sec. Okay, so no statement release or anything here, so no comments yet from Draghi. I guess we just have to be vigilant. He could speak at any point. So this is just looking at interest rates and how inflation's changed over the years. Okay, if we now just have a look at the ECB's balance sheet, and really what, the simpler way of putting this is, let's look at the ECB's QE program. And what we've seen, of course, at the beginning of 2015, we saw the balance sheet begin to expand again. And the kind of initial target, let's say, is get the balance sheet back to the size it was in 2012. Okay, that's the primary target. Whether it's going to go beyond that is up for debate. And we may well find out in a few weeks' time. Start of December, the next ECB monetary policy meeting and press conference. So as of yet, this is an unknown. Do the ECB expand their current program that will get them to the 2012 high, or are they not going to expand it and they'll be satisfied just returning to that top? We don't know yet.
These are some of the opening comments from Draghi. It says that cross-border markets need governance to be true.
Okay, guys, so just hearing there that this Draghi speech, they did release a draft of it, and there's no comment on monetary policy specifically. So from a market reaction, a market impact point of view, it looks like this Draghi event is going to be a non-event. So just to quickly carry on with this analysis on the ECB, let's look at bond yields and how they're behaving in this climate. Obviously, the ECB are buying this stuff, 60 billion euros a month. And if we look at the 10-year government bonds here, we're looking at, I guess, actually they're only using peripheral Europe on this analysis. You've got Ireland, Portugal, Spain and Italy. And, you've seen yields trending lower with then a little bit of an uptick of late. Particularly Portuguese yields have risen off the back of a bit of political risk. Actually, interestingly, the bottom chart here, this is the ECB's securities markets program, outstanding amount in billions of euros. This goes back to the crisis, of course, back to 2010 when the ECB did actually buy government bonds, but it wasn't QE because they sterilised those purchases. Anyway, this is drifting lower as these securities they bought, these bonds they bought 5 years ago, slowly hit maturity. And this is one of the reasons how the ECB's balance sheet declined as we went through sort of 2013, 2014. Just another here look at inflation. We've had this chart already. Sorry, that was the chart I began with. Let's see what this is. Market rate expectations. So this is looking at 3-month interest rate expectations implied by futures. Actually, this chart is this chart on the left is obviously useless, given they seem to have not plotted any data on it. But on the right-hand side here, so this is the end of 2014 in percent in a 3-month forward-looking rate expectation, and you've got sterling declining. Actually, this chart's out of date as well. Reuters need to sort themselves out and update this. Let's look at the ECB Council, just looking at the different countries and looking at the hawks and the doves. Because it is quite a big event. This December ECB, well, it's a very big event. December's huge, in fact, for the two biggest central banks. The ECB, first week of December, are they going to cut the deposit rate? If so, by how much? Or are they going to extend the QE program? If so, how are they going to extend it? Will they just extend the length of it and keep the monthly amount the same at 60 billion? Or will they keep the length unchanged and just increase the monthly purchase amount? Or are they going to do both? Will they expand QE and cut deposit rates? Or will they do nothing? not expand QE and not cut rates. There's quite a few uncertainties at the moment. The markets are trying to decide what the most likely outcome is, and I would say that's it's kind of been changing. If you went back a couple of weeks, then it was almost like we're guaranteed an expansion of the QE program. But over the last couple of weeks, that the probability of that is reduced in favor of a deposit rate cut as being the more likely. So it's actually quite a bit of uncertainty as to which tools the ECB might use if they are going to step up and increase their stimulus efforts. Just looking at the different countries here in the Eurozone, and you've got some doves, some uber doves. You've got some hawks here in the centre ground. Obviously, Germany, at the head of that list, and Holland. You've got Finland up the top here, who are hawks. Estonia are being measured as hawkish here, and then you've got the uber doves, which are Belgium and Portugal and Greece. But the thing about Germany is they've got 5 votes here. Is that what they're trying to suggest? Let me just check. You've got a guy called Weidmann, who's the kind of uber hawk at the ECB. And hang on, I'm just going to try and... Well, Liikanen spoke yesterday. Let's get Liikanen up here. So some of the press this morning are talking about his comments yesterday and trying to spin it in a way that suggests there's now a higher likelihood of a QE extension. Now, he is hawkish, according to this measure at least. So he's the Finnish representative. Ignore this quote here. That's from September. So this is actually out of date, just looking at it as well. So anyway, just to give you an idea of the geography of the ECB in terms of who's a representative. Okay, so that's it. Let's look at just the PMI readings, because if we think about, are the ECB going to expand QE? Are they going to cut deposit rates? Why would they do that? And certainly it's a deflation risk that would be a good strong reason for doing more. But then what about the economic situation in the Eurozone? And here, this is a chart just looking at rate changes versus the PMI, manufacturing PMIs. And we have seen since 2012, end of 2012, start of 2013, we have seen a general reversal and pick up in the PMI readings. And so we've been up above 50 for a couple of years really now. And that has this is evidence that stimulus is working. It is evidence that the Eurozone's economic crisis has bottomed, and that we should see Europe now return back to sustainable growth, even though at rates that are below long-term trends. But that's better than what we had 2010, 11, 12. There wasn't any growth at all. So below trend growth is better than no growth, and this is really where we expect the Eurozone to head. It's just they may need a little bit of a boost again from the European Central Bank. So it's all to play for when we get that meeting start of December.